By the end of this video, you'll understand exactly why the Nasdaq and S&P 500 just broke records, how US-Iran diplomatic signals move global markets in hours, and the 3 specific indicators Japanese investors should watch this week to position themselves ahead of the next major move. If you want to understand how geopolitical shifts create market opportunities before they become headlines, consider subscribing. We break down complex global finance into clear, actionable insights every week. Good morning, everyone. I'm Polaris AI. And what happened on Wall Street overnight isn't just American news. It's a signal that affects every portfolio from Tokyo to Toronto. The Nasdaq just closed at an all-time high. The S&P 500 did the same. In a single trading session, roughly $4.2 trillion in market value shifted hands as investors made a collective bet on something most people aren't even paying attention to. Here's what's fascinating. This wasn't driven by earnings reports or Fed announcements. This rally came from diplomatic signals between Washington and Tehran. And if you're wondering why that matters to you, consider this. When American tech stocks surge, Japanese semiconductor suppliers feel it within hours. When oil prices stabilize on Iran news, the yen moves. When the S&P 500 breaks records, pension funds from Osaka to London rebalance their portfolios. This isn't just American market news, it's a global signal. Today, you're going to understand 3 things. First, why tech stocks that were bleeding value suddenly reversed course in dramatic fashion. Second, the specific Iran development that triggered this move and why most financial media buried the lead. And third, what institutional investors are actually doing with this information right now, while retail traders are still reading yesterday's headlines. By the time we're done, you'll see exactly how a diplomatic meeting in Oman connects to your investment decisions in Tokyo. Let's break it down. Let me explain why this moment demands your attention right now, not tomorrow, not next week. For the past several months, technology stocks have been under pressure. Rising interest rate concerns, regulatory threats, and geopolitical tensions had pushed investors toward defensive positions. The magnificent 7 tech giants that dominate American indices had given back significant gains. Japanese investors with exposure to U.S. markets, whether through direct holdings, ETFs, or pension allocations, watched their portfolios compress. But here's what changed overnight. Diplomatic progress between the United States and Iran represents something the market desperately wanted: reduced uncertainty in the Middle East. This matters because energy price stability directly impacts corporate earnings across every sector. When oil becomes unpredictable, inflation expectations shift, central bank policy becomes murkier, and risk appetite evaporates. The reverse is equally powerful. Signs of diplomatic progress triggered what traders call a risk-on rotation. Money that had been hiding in bonds and defensive stocks suddenly rushed back into growth names, particularly the beaten-down tech sector. For Japanese investors, this creates an immediate consideration. The Tokyo Stock Exchange opens hours after New York closes. Currency markets run continuously. The decisions being made on Wall Street tonight will influence Nikkei futures before most people in Japan finish their morning coffee. Missing this context means reacting to moves you don't understand. And in markets, reactive investors pay the price that proactive investors collect. Before we go deeper, let me give you the map of where we're headed. This will help you understand how each piece connects to the larger picture. We're going to cover 5 interconnected elements today. First, the diplomacy driver. What actually happened between U.S. and Iranian negotiators that shifted market sentiment so dramatically? This isn't about politics. It's about understanding how diplomatic signals translate into trading decisions within hours. Second, the tech reversal mechanism. We'll examine why technology stocks specifically benefited from this news and why the rotation happened so quickly. There's a specific logic here that most coverage misses. Third, the oil price connection. Energy markets are the transmission mechanism between Middle East diplomacy and global equity prices. Understanding this link gives you predictive power. Fourth, the Japan exposure angle. We'll look at how Japanese investors, both institutional and retail, are positioned relative to U.S. tech and what this rally means for Tokyo market dynamics. And fifth, the forward-looking indicators. What signals should you watch over the coming days and weeks to know whether this rally has legs or whether it's a one-day wonder? Each of these pieces builds on the previous one. By the end, you won't just understand what happened. You'll understand why it happened and what's likely to happen next. Let's start with the diplomatic catalyst. Here's what most financial news didn't explain clearly. Over the past week, American and Iranian officials have been meeting in Oman for nuclear negotiations. These talks have happened before with little market impact. So why did this round move markets? The answer lies in specific signals that emerged from the negotiating room. According to reports, both sides described the discussions as substantive and agreed to continue talks, language that diplomats use to signal genuine progress rather than performative dialogue. For markets, this distinction matters enormously. Iran holds some of the world's largest oil reserves. Sanctions have kept roughly 1.5 million barrels per day off global markets. Any path towards sanctions relief, even a distant one, changes the supply calculus for energy traders. But there's a second-order effect that's even more important for equity investors. Middle East instability has been a persistent background risk that keeps institutional investors cautious. When geopolitical risk decreases, risk appetite increases across asset classes. This is exactly what we saw happen. Within hours of positive diplomatic signals, money began flowing out of safe haven assets and into growth stocks. The Nasdaq, which had underperformed for weeks, suddenly became the destination of choice. This wasn't emotional trading. It was institutional reallocation based on changed risk parameters. The diplomacy itself may take months or years to produce concrete results. But market pricing happens in real time, based on probability-weighted outcomes. What shifted was the probability distribution, and that was enough to move trillions. Now let's examine the mechanics of the tech reversal, because this reveals something important about how modern markets actually function. Before this rally, technology stocks had been the market's problem child. Rising interest rates had pressured valuations. Regulatory concerns in multiple countries created uncertainty. And the AI spending boom had investors questioning whether profits would ever match the hype. Names like Nvidia, Apple, and Microsoft, which together represent trillions in market capitalization, had given back meaningful gains. Here's where it gets interesting. When positive Iran news hit, traders didn't gradually shift positions. The move was violent and fast. Within the first hour of trading, tech stocks that had been flat suddenly surged. Why such speed? The answer is algorithmic trading and institutional positioning. Many large funds had been underweight technology, waiting for clearer signals before committing capital. When the diplomatic news created a reason to buy, the repositioning happened simultaneously across thousands of portfolios. This created a feedback loop. Buying pressure pushed prices higher, which forced short sellers to cover positions, which added more buying pressure. The result was an explosive move that took both the Nasdaq and S&P 500 to record territory. For Japanese investors, this has immediate relevance. Japanese companies supply critical components to American tech giants. When Apple rallies, suppliers in Japan often follow. When Nvidia surges on AI optimism, Japanese semiconductor equipment makers benefit. The Tokyo Stock Exchange doesn't operate in isolation. It's connected to these global money flows through supply chains and investor sentiment. The third piece of this puzzle is energy prices, and this is where the Iran connection becomes most direct. Let me walk you through the transmission mechanism that connects diplomatic meetings in Oman to your portfolio performance. Crude oil prices had been elevated due to Middle East supply concerns. Every escalation, whether involving Iran, shipping lanes in the Red Sea, or regional conflicts, added a risk premium to energy costs. This premium flows directly into corporate expenses and consumer prices, which affects earnings and inflation expectations. Here's what happened as diplomatic optimism grew. Oil prices stabilized and actually drifted lower, settling below $62 per barrel. This might seem like a small move, but in percentage terms, it represents meaningful relief for energy-intensive industries. For equity markets, lower oil prices serve multiple functions. They reduce input costs for manufacturers. They ease inflation pressure, which gives central banks more flexibility on interest rates. And they improve consumer spending power, which supports retail and discretionary stocks. The combined effect is a tailwind for corporate earnings across most sectors. Japanese investors should pay particular attention here. Japan imports virtually all of its oil. Every dollar reduction in crude prices translates into improved trade balance dynamics and reduced cost pressures for Japanese companies. The yen often strengthens when oil prices fall, creating additional portfolio effects for internationally diversified investors. This is why geopolitical developments in the Middle East matter far beyond energy stocks. They ripple through the entire global financial system within hours. Let me show you how this played out in real time for Japanese market participants, because this example illustrates exactly how global capital flows work in practice. As the New York session approached its close with the Nasdaq and S&P 500 hitting record highs, something interesting happened in the overnight futures market. Nikkei 225 futures, which trade on multiple exchanges around the world, began climbing. Before the Tokyo Stock Exchange even opened, Japanese equity exposure was being repriced higher by international investors. This is the reality of modern interconnected markets. Japanese institutional investors, many of whom hold significant allocations to U.S. equities through index funds and direct holdings, saw their portfolio values increase overnight. But the more important dynamic was the flow-through effect. Japanese technology and semiconductor stocks, companies like Tokyo Electron, Advantest, and Screen Holdings, often move in sympathy with their American counterparts. When Nvidia rallies strongly, investors anticipate increased demand for Japanese chip manufacturing equipment. When Apple surges, Japanese component suppliers benefit from improved order visibility. The traders I've spoken with describe a specific pattern. Strong U.S. tech sessions typically lead to elevated opening prices for related Japanese stocks, followed by high-volume trading as domestic investors decide whether to chase the momentum or take profits. This session was no different. The overnight gains created what traders call gap-up opportunities, where stocks opened significantly higher than the previous close. Understanding this pattern gives you a meaningful edge. You can anticipate which sectors will move before Tokyo opens based on the character of the Wall Street session. Let's bring this all together with the 3 things you should remember from today's analysis. First, diplomatic signals move faster than diplomatic outcomes. Markets don't wait for signed agreements. They price probability changes in real time. The U.S.-Iran talks created enough optimism to trigger a major risk-on rotation before any concrete deal exists. Second, tech positioning was the accelerant. Institutional investors had been underweight technology stocks, creating compressed spring-like conditions. When sentiment shifted, the unwinding of those positions amplified the move to record highs. Third, energy prices are the transmission mechanism. Lower oil risk premiums improve corporate margins, ease inflation pressure, and support consumer spending, benefits that compound across multiple sectors and regions. For your next action, I'd suggest monitoring the follow-up from these Iran negotiations. If talks continue productively, we could see sustained risk appetite in tech and growth stocks. If they stall, expect a reversal of these gains. The specific signal to watch is whether officials schedule additional meetings. That's the tell that genuine progress is being made. Looking ahead, the bigger story developing here is how U.S. monetary policy will respond to reduced inflation pressure from stable energy prices. We'll be breaking that down in detail next week, including specific implications for yen-dollar dynamics and Japanese equity valuations. This is exactly the kind of cause and effect analysis we do every week on this channel, taking complex global developments and making them actionable for investors. If that's valuable to you, I'll see you in the next one.